Understanding Investments a Few Minutes at a Time by Daniel Dower from Chapter 9, Fundamental Analysis, Issue Number 42, Consolidating Balance Sheets. This issue came to my attention after meeting with several individuals who steadfastly insisted they'd never buy stocks on margin because borrowing to make investments is a risky proposition. Yet these same individuals paid no heed to the debt incurred by the companies whose stock they owned. Intuitively, something's not right. The solution is tedious and not meant to be followed literally, but rather something to keep in mind whenever spending your hard-earned money on any investment. Dismissing this issue cavalierly may cause harm to your portfolio and all that hard-earned money. When you plan for retirement, you may plan on earning $30,000 from a pension, $20,000 from Social Security, and $40,000 from investments. You may plan on spending $30,000 on housing, $20,000 on travel, and $30,000 on other stuff, adding $5,000 to your investments and saving $5,000. If you were the sole proprietor of those investments, let's call it a donut shop, you might carry that thought process a step further. You would know that you make $500,000 in annual sales, and that it costs you $460,000 to pay all the business expenses. If you consolidated the business budget with your budget, it looks different, but the end result is the same. The difference is that it focuses your attention on just how important it is to keep business expenses down, or else you'll need to raise prices or sell more donuts. You may decide to increase profits by investing that $5,000 into some new equipment. You're consolidating the income of the business into your own planning, as well you should. Thinking about balance sheets takes a little more concentration, and you may need to review this section a few times before it sinks in, but the lesson is well worth the effort. Let's call the guy who borrows on margin to buy more stock Mr. Risky. On his personal net worth statement, he lists assets such as bank accounts, investments, cars, and house, as well as liabilities such as car loans, the mortgage, and margin debt. Now consolidate the balance sheet like you might do if you were the sole owner of the business. Whether you know it or not, as a shareholder you are an owner. Think like one. For this exercise, let's assume these investments are all stock in Coke. The share price is $39.11, so he has 10,228 shares out of 4.39 billion total. He is a 0.000232% owner of the world's largest beverage company. For purposes of these calculations, I'm going to use a simplified version of enterprise value. The enterprise, or assets that make up a business, is equal to the market value plus debt. This thought process follows the accounting rule that assets equals debt plus equity, assuming equity is market value. Coke has assets of $233 billion and liabilities of $61 billion. Mr. Risky's portion are $543,995 and $143,995 respectively. Let's repeat the analysis for Mr. Safe, but rather than buying Coke, he buys General Electric. The price-to-earnings ratios are both 20, and he has similar opinions about their future growth, stability of earnings, and so forth. Other than not borrowing to buy more stock, and the choice of which company in which to invest, everything is the same. GE's price is $26.04. So Mr. Safe has 7,682 shares out of 10 billion total shares. He is about a 0.00077% owner of a global industrial conglomerate. GE has assets of $777 billion and liabilities of $518 billion. Mr. Safe's portions are $596,610 and $396,610 respectively. Most likely to his surprise, for all practical purposes, Mr. Safe has incurred more debt than Mr. Risky, $576,610 versus $523,095. GE uses more assets and liabilities than Coke to generate the same amount of earnings. GE's debt to enterprise value ratio is 0.66 versus 0.26 for Coke. By haphazardly purchasing stock in a company that uses a lot of debt, Mr. Safe has effectively borrowed more than Mr. Risky.